The title of this session is CEO Big Debate, Adapt, Innovate, Thrive. Which models will have the edge and why? And we have an absolutely fantastic panel, so thank you all for joining us today. We're really going to try and be forward-looking today, and I've asked, or Peter asked, all of our panelists to think about looking at the future of their businesses, to think about how they might adapt, innovate and thrive, thinking about how their business will respond and how the market might look. I'm not going to take you in order because I've got a plan in my head. So Andy, if I could start with you, please. If you can, I think everybody knows you, but maybe introduce yourself and talk about how you're thinking about your business in the future.
Okay, thanks, Heather. You all hear me okay? Yeah, my name's Andy Bell. I set up AJ Bell nearly 27 years ago now. And over that time, we have had to reinvent ourselves on several occasions. So I think some of the examples we saw there feels very much like we've been there before. I think the challenge is to carry on doing it. But if we just maybe start with our business model, I'll probably define that as a dual channel, single operating model business. Really, what that translates to in simple parlance is. We have two platform propositions, AJBL Invest Centre, the advice proposition, AJBL You Invest, our D2C proposition, and both of those sit on effectively a single IT stack. We also support that with a low-cost investment business, all really multi-asset based. And the one thing we don't do is advice. Over the 27 years, I've done business with lots of advisors, and I've committed to many along the way that we wouldn't give advice, and whilst I'm running the business, we never will. Personally, I think to actually try and run a D2C platform, an advice platform, and an advised business, it makes for the difficult management of a channel conflict. I think I'm not saying it's impossible. I think you've got to bring your advisors, the independent advisors who use your advice platform, somehow persuade them that neither the D2C nor your own advice business is a challenge for them. When we're thinking about over the years, when we've tried to change the business, I'm a big believer in you've got to have certain aims that sort of sit a bit higher than the day-to-day issues you need to deal with. So probably our biggest driver in the business is ease of use. Whenever we're doing a new project, we always look at it through an ease of use lens. Is it making life easier for our advisors, easier for our customers, easier for our staff? And if it doesn't pass that test, then we say, well, actually, why are we doing it? There might be other reasons, but in the main, that has worked well for us. It stood us in good stead. Next level down levers, we tend to think of our platform propositions in terms of really price, service, and functionality. And probably recognise it's very easy to say those things and say we want to be the best at all three. Well, actually, there's tension in those three. You can't be all things to all people and still be very competitive. So along the way, we've had to decide where we sit in that, and there's a journey we're on at the moment, and I'll touch upon that as we go along. And I think it's more into the broadening our horizon. Broadening our market, going down the AUA chain, often to younger, less experienced investors. So really becoming a broader church than we have been in the past, and that will drive our behaviour. And on the how do we sort of think about our business? I was exchanging with Heather yesterday about whether we just see ourselves as dual channel, and we don't. I think dual channel is a very easy way of describing our business. I think what we've seen over the years now is the advised market and the D2C market have both grown to a maturity level whereby it's not just a one product, one proposition will suit the D2C space, and one proposition will suit the advised space. And again, using the electrical analogy there, I think there is a danger that what we could do in recognising that the market is changing, needs are changing, expectations of customers are changing. What we could try and do is just replace one or two of the key engine parts in our existing propositions, and think that will tick the box. Personally, we looked at that and decided that that wouldn't be the case for us. So for those who followed us in a bit more detail, we've announced recently that in the D2C market, we're going to launch a new proposition called Doddle by AJ Bell, and in the advised market, Touch by AJ Bell. So two new propositions, both sitting alongside our existing advised proposition. So Doddle, for example, is app only, 15 basis points, all in custody charge, no dealing commissions, full range of wrappers, SIP, LISA, JISA dealing account, access to the most popular UK stocks, US stocks to follow shortly after launch, in-house AJ Bell funds, and a curated best buy list of themed investments. So really what we're trying to do there is hopefully, as it's fairly obvious, you go into that younger market. Some of those younger people, we've seen them be diverted off to some of the free commission trading apps. I think for some of them that's you're perfectly fine. I think some of them we see they're not really up to the job of day trading. That's not our market. We don't do day trading. So really what we're trying to do is say for that younger audience, there is an alternative that allows you to get what I would see as a sensible portfolio that would stand scrutiny by people in this room without too much effort and too much challenge, and without spending an awful lot of money in doing it, or an awful lot of time, which is important for these guys. Touches are following a similar theme. It's digital only, aimed at the next generation of advisor and or the next generation of customer. It could be current generation of advisor advising the next generation of customer, but the interface with the customer is all tablet based. So both of those are ongoing at the moment. Well, maybe take a step back and just look at the markets. What's sort of driving our thinking behind that? So the market, I think there's a general perception that the D2C market is growing an awful lot faster than the advised platform market. It's actually not the case. If you look back over the last 8 years, both D2C and advised platform space have grown at around 13% per annum compound. Advised platform has always been about 2/3 of the overall platform space, being fairly steady. So both of those are, people often challenge me, which would I prefer? Well, I think both sit very neatly together with the operational leverage we get off the single IT stack. When I look at that market, whenever we're actually looking at the price part of our price, service and functionality, you've got to be careful not to be distracted by the new kids on the block who are bringing in what I would view as unsustainable pricing models. When we look at our pricing, we try and focus on our credible peers, as we would call them, those that either have scale or profitability. If you don't have scale and don't have profitability, it's I think at some stage they may get there, but I think we've got to be careful not to be diverted very quickly and start slashing our prices just to react to something that we don't need to. And actually, at the end of the day, I'm in this business to make money, and I think there's a few too many platforms who actually don't make money. I'm not quite sure will ever make money. And a barrier to entry is a massive. Your scale is a massive barrier to entry in our market. We've got about 75 billion of assets we look after. Last year, our gross inflows were 11 billion. It's quite difficult for someone new in the market to come in. I'm not saying impossible. There's lots of actually really good apps out there that are coming into the market, challenging firms like us. What are we doing? We can't just sit there, otherwise these guys will eat our lunch. But it's sometimes easier in a perverse way. Not all industries are like this, where it's easier for us to reshape what we do than maybe those guys to come and get the scale to go and take it on. Final comment I would make is just in relation to advice. Again, I was talking to Heather about whether there's a space for advice and execution only to be combined. I like the fact that we know our customers are either advised or they're either execution only. I think to start trying to merge that, it can blur the relationship you have with your customers. I think I look at robo-advice. There's been an awful lot of articles written over the years, and it's never quite gained the traction. There are some examples you can say actually that's worked quite well, but really, if you look back 5 years ago, in this sort of audience, we've been saying robo-advice is going to dominate. I don't think it has. And I think we'd all recognise that face-to-face advice is not only the gold standard, but it's something that you can't put out there in scale. We can't expect the whole market to be advised face-to-face, because people just can't afford to do it at the quality that and the cost that that actually follows. So one of the things that we've, our focus in that is not to go down the advice route, as I say, but I think where platforms can play a really important part is on guidance and, conscious of the best buy lists of, I've had a, you certainly had a bloody nose for well publicised reasons. I think we're careful not to throw the baby out with bathwater on this one. There's an awful, we hold an awful lot of data. Sit that alongside PERG, the guidance between advice and guidance, and you're going to find that actually PERG is actually trumping the new consumer duty, which I don't think is right. I know the FCA are looking at this at the moment. I wrote an article in Money Marketing earlier in the week on this point, and I think there is something that actually two examples. One, we've got we're not allowed to put our D2C customers, we're not allowed to give them access to a risk profiling tool that in any way gets them to an investment that would map onto the output of that risk profiling tool. Otherwise, we're brought into the advice world. And secondly, if we know our customers, we're open architecture, so I think I don't buy the argument we shouldn't hold dog funds on our platform, but we know what the dog funds are. We know there's also very similar funds at far lower charges, far better performance. We're not allowed to match up our customers who hold the dog funds with these other funds. Again, it would be seen as an advice event. So I think platforms have got an important part to play. The regulator's got to come along on that journey, help us by just relaxing the boundary. I would prefer a relaxed boundary rather than a new regime, which is one of the things that's being talked about. But I think at that point, then we, along with other things like Hargreaves announced an augmented advice, where I think all of these things will work together to try and eliminate the advice gap that is definitely out there. So that's all I can say. Thank you.
Thank you. Really helpful and sets the stage really well. Excuse me. Claire, can I come to you next?
Yeah, so just a bit of background on me. I'm the MD for Retail and Savings for M&G. M&G is effectively the bringing together of the old Prudential UK and M&G, the asset manager. And fundamentally, for me, my role is to basically make sure that we sell the strength of our asset management proposition to retail customers and institutions where we're leveraging our balance sheet. And the two elements of the business for M&G is the asset manager and then my role in terms of retail and savings. Fundamentally, for me, if I look at the last 2 years, I think the pandemic has fundamentally changed how everybody looks at everything. So technology has been a key player. If you look at advisors and if you look at customers, the percentage of them that are actually now using technology and expecting that from us as an industry is absolutely flipped, in my view. So some of the metrics and the targets that we had pre-pandemic and where we sit today as a business, they really have shifted. And I think that creates an expectation on us as platforms, as providers, to basically deliver those outcomes to our customers. I have a slightly different philosophy to Andy in terms of the kind of the distribution channels. We have built out a business, an advice business, based off our back book. And the back book, for me, has been one of the areas where our customers have really struggled to get help and support. And what we've done over the last 6-7 years is built an advice business that has been able to provide that support and then generate future value. We obviously have just bought Sandringham as part of broadening that advice channel. We've also done a joint venture with Money Farm from a D2C perspective, and we've also launched hybrid advice. My philosophy is that we need to be able to provide to our customers and our advisors all elements that allow them to be able to do and transact and enable them to basically save for the future, leveraging our asset management capabilities. So for me, the advice, guidance, support, and the asset management are the two elements of the value chain, which is where we can make a real difference. The administration is about doing things really well, so I describe it as brilliant basics. It is about scale, but if you don't do those basics well, then we basically will not have the customer support that we need. And the industry has had a history of really not doing that very well. Overcomplicating it, So my philosophy is we have to do that very simply, use of technology and commercially at the right sort of price. So I think there's a fantastic opportunity for us to reimagine, but I think the customer demand and the advisor demand is forcing us, or is going to force us, to basically reinvent ourselves as an industry.
I remember there was a term used around the introduction of the RDR, the over-complexification of financial services, and it certainly hasn't gotten better, has it, since then? Tim, can I come to you next? Tim Goodhind has kindly stepped in for Hamish Purdy. Can I come to you next, please?
Yeah, of course. So just to briefly introduce myself, I'm the Chief Revenue Officer at FE Fund Info. We're a provider of, effectively, we're a data business, purely focused on the fund industry, and then basically technology business as well. And we really service two core communities, which is the advice process, particularly mostly in the UK, and then more broadly in Europe, the fund distribution business. So within the advice business, our focus is on effectively providing a simple, compliant, scalable solution to our advisors, which basically enables both the optimum customer journey and effectively the most efficient journey for the advisors. So there's been a number of studies into the sort of industry, but around about a quarter of advisor time is wasted by poor integration and poor solutions. And so from our perspective, being able to enable that journey, both from the client perspective, so therefore, simple things such as in the onboarding process, the hard fact, gathering, the fact find, the attitude to risk, you don't need to be face-to-face with your advisor to do it. It's, effectively, a use, but not a productive use of the advisor time. And ultimately, from a consumer perspective, you'd rather do that in your own time. Then when you do get down to sit together, you can have a quality conversation that essentially is around your plan, your goals, and the things you want to achieve from your investment capabilities, and rather than necessarily talking around the spelling of your surname or other sort of more prosaic matters. So that's on the advice side. On the fund distribution side, we're effectively all about, from our perspective, enabling that fund distribution and then removing what we would call the overlying tax in that process. So within the fund distribution process, there's obviously a lot of effectively regulation hurdles you need to jump through, whether it's MiFID, et cetera, et cetera. So there's a range of templates, there's KID documents, there's everything else which needs to be produced. And the challenge for many of our customers is ensuring that they get consistent data out to market, they get consistent documentation which reflects that data out to market, and that they get that out to all of their venues. Now, the combination we've seen between the three is that there's, effectively a big shift to digitization, which we've talked about already. COVID, everyone knows that massively accelerated that process. But that's the same in both the advice process in terms of the way you engage, but also in terms of the distribution process. We see a way that more and more of the end distributors are then, obviously moving to a digital world. So therefore, they need to verify the data as it comes in. If the information is incorrect, you could see a way that distribution channels would refuse to take fund manufacturers' product unless they can be sure that the data is accurate because they have a duty of care. So that requirement to clean the data, analyze the data, optimize it is fairly critical. So from our perspective, they're the two sort of key industries. So that shift to digitization is pretty key from a theme one. Theme two is effectively into the data and the requirements, and I think there'll be more and more focus. 10 years ago, data wasn't necessarily seen as the asset it is today. Now everyone realizes it's the sort of the power that most of our businesses, sort of run on, whether it's customer insight, market insight, or however it happens to be. So we see a big shift to there, and Andy talked about open architecture earlier. We would see that in two ways. Prior to joining FE Fund Info, I was with a company called Finastra in the open banking world, and the asset management world has a little bit of catching up to do in terms of compared to where the banking world has been. Now not everything in open banking and open finance has been a success in terms of the way that people expected it to be adopted and how to be used. Nevertheless, it has significantly changed the way that people are able to interact and able to access their information. So that open architecture approach, we intend to embed. We need to, frankly, improve our own technology so we can come through, without wishing to bore you with a lot of tech speak, RESTful APIs. We need to, coming into the industry, it surprises me how much is still done on batch files, and there is very little event notification, so information gets sent out, but you don't necessarily know whether it's been received. So an ability to actually know whether you're delivering on the promise you've made to your providers is not necessarily there. So they're really the three key themes that we see in the business and that we're investing significantly behind. Obviously we acquired Cash Cow to increase our advice journey, and whilst we're waiting for regulatory approval in the UK, we've recently acquired a business on the sort of institutional side of the business called FundSquare, which does a lot of fund registrations out of Luxembourg, which will enable us to really simplify that whole process, which is a major drag for businesses such as Peter's. And with that, I'll hand over with Peter.
Very good transition. Thank you. You should host instead of me. Peter, over to you.
So we're very much an advice business. So Schroders has got the Casino business, which goes everything from the ultra high net worth business of Sandaire right the way through to Schroder Personal Wealth, which is our joint venture with Lloyds, which is fed by Lloyds referrals through the Benchmark business and the Fusion platform, but fundamentally around advice. And I'm going to come back to your Faraday challenge in a minute, because I think if we look back over the last 2 years and the arrival of lots of have-a-go people, what you've seen is a massive destruction of wealth. And I think if you the best example I see is Cathy Wood's funds in the States, where if you look not the time-weighted performance, but the money-weighted performance, you've seen billions and billions of dollars of wealth destruction. The statistic I was given the other day, there's more crypto holders in the UK than there are holders of UK shares. These things are people who are speculating rather than investing, and our industry is not enabling people to have good long-term retirements because the way in which they're accessing those investments is not driven by good advice and good long-term results. And I think, why is that? And I thought that the other thing you'd say is the buy-to-let boom we saw in the UK was again, if we look back, and we're really judgmental about our Faraday moment, were we offering things? No, so everybody went away and did buy-to-let because they thought, actually, savings, they don't really work for me. And so you say, why is that? Well, you've got a UCITS regime which is 35 years old. In the US, I always think it's quite ironic that the 40 Act fund, which governs mutual funds, is exactly 1940. We're using technology which is 80 years old to try and help people do their savings. We've got a public markets which are shrinking. All the interesting stuff is happening in private markets. You've got a UK market which is even less attractive than the average public market. The UK market is flat since 2000. The US market is up threefold. So although the UK is a centre of much of the innovation that goes on in the world, none of that's being captured by UK savers. And the DC market is the worst manifestation of that. So, it's not surprising that you're challenging us, because I think there is a need to stand back and say, why is everyone doing buy-to-let? Why is everyone doing crypto if we're not, as an industry, providing something which is more relevant to them? So I'll get to the challenge a little bit, but I think there's two things to my mind. As an industry, we've sold two things, risk and return. And we've expected people to talk our language and wake up in the morning and want equities or bonds or whatever. And that is not the way the rest of the world speaks. And I think we need to think really hard about what it is that what their values are, and how they want their values reflecting and their impact they want to have in the portfolios they have. So I think the first piece of that journey is to say, is there a third dimension to our industry, which is about what people feel and believe and want, which I think is much, much greater than we currently allow it space for. And we don't really have good tools for embedding that and thinking that they're still quite blunt. And the second is, how do we merge this whole public markets and private markets? And the regulations aren't there yet, but they will change. But I think if you look to the US, the only people who buy mutual funds these days are baby boomers. Every person under the age of 40 would expect to have ETFs in their portfolio, not mutual funds. Now, the tax regime is different. You would see far more ownership of privates in everyone's portfolios. You would see a much greater immediacy about people's link with their long-term savings, insofar as we don't articulate the role that people's savings play, I think, in anything like as good a way as they do it in the States. And so to my mind, we need to look we look overseas rather than our own UK ecosystem, which is still a fantastic industry. It's an incredibly profitable industry. There's a very good reason why 5 or 6 PE firms are going around trying to buy up everything in the industry. They're making an awful lot of money out of it. But we've got to think, is it doing the right thing for long-term savers? So to my mind, there'll be two big pivots. One is that we embrace people's values more, and the second is that we find more ways to work with regulators to get more of the innovation and creativity of the UK into people's portfolios. And I think part of that will be achieved through tokenization over time. So if you stood back and say, what could this look like on a 10 or 15-year view, I do think automated advice will play a bigger part. But I tend to agree with Andy that it's still the subject of lots of articles and it's a long, long way off. But there's a lot more that we can do in helping legislation, allowing people to buy into different sorts of assets in different ways with smart contracts, which will free up some of the guff and not just talk about structures which are 30, 40 years old. Sorry, I was just trying to be a bit provocative for you.
Yeah, no, fantastic. And I think it's really important, right? Because it's our industry prides itself on being safe and cautious, but in trying to engage with other generations, does that tone need to change? I think there's been some comments around ease of use, guided architecture, the need for you think about that paradox of choice that people talk about, and whether you're paralyzed because I think there's more funds than there are listed equities. There's these sort of weird dynamics that exist. We're competing not with each other in the room. We're competing with buy to let. We're competing with Bitcoin. We're competing for attention with everything. So there's a lot of challenges. We talked about scale and the operational prowess that businesses need. We talked about reaching younger investors and how we change that and how we reach that next generation. And it's interesting because I think a lot of the tech focus has been on reaching that next generation. And Tim, you talked about how do we support and service financial advisors who are reaching our existing customers who are also frustrated by the tech that exists in our industry. So I think that sets us up really, really well. And I'm scanning the room because I have this mic I can throw around. So I will scan the room. But first, I want to come. I'm looking around. I'm going to come to Andy while you all get your questions ready. And Alex has a microphone upstairs, so if there's someone upstairs who has a question, they can put their hand up as well. I want to come to Andy to react to some of the things that Peter was saying about tokenization, private assets. I think if you look at the returns of private assets over time, they exceed public markets. Volatility and risk is higher. There's arguments to be made why that's a risky asset and might.
Volatility risk isn't higher. Sorry.
Fair
I
point.
think the stability of the NAVs is actually a good way of keeping people in for longer.
Yeah. Okay. So when we research with financial advisors, they don't hear from their clients' appetite for investing in private markets. We hear it from DFMs, wealth managers, asset managers. We don't hear it from financial advisors. It does come up. I know April Ruden's going to be on later. She might reference this, but in the Capgemini World Wealth Report, there is appetite from high net worth, not just ultra high net worth investors in accessing private markets. I'd be interested in your perspective on that.
Yeah, but lots of thoughts. As a personal investor, I have quite a few private investments. I think the difficulty is in making it available to the mass affluent market. I often use the Neil Woodford example as the irony there is that Neil invested in us back in 2007, and we were probably one of his best investments during that period as a private company. He had to sell out just before we listed, and we all know the well-documented story there where people have been critical of the way private equity has been held within open-ended funds, and I think there's a regulatory piece there as to how we find that. I think, if I'm honest, the only way you can hold private equity is probably in closed-end vehicles. I just don't think it works in open-ended. You've seen property exactly the same. Liquidity crunches coming. So I think the challenge for the industry and for the regulators is to find a way. I don't think there's any lack of demand, but I think most financial advisors probably take the same view that we take as a business, actually, it's not what we do. You know, there's other people out there will serve that need, but actually our job is about, you know, taking cash in and allowing people to go on the phone and buy and sell an investment and hopefully hold it for a long time. With those other vehicles, it's very difficult to do that. So I'm all for it. I probably have slightly more jaundiced views when you get further out into the risk world, such as your crypto and the like. But I think on your private investments, which for me, you know, typically shares in private companies and property, then I think there's a challenge for the industry to find a better way of doing that.
Claire, I'd be interested in your views on that as a wealth manager fund group and owning platform. You're covering the spectrum.
Yeah, so my views will be very similar to Andy's on this, is that I think there is a place in the market for it. It's interesting, if you look at our With Profits fund, that's exactly what we do, is we basically invest in a whole range of different assets across the geographies, privates, publics. But the way that we can do that is because you've got liquidity from the other assets in order to be able to manage it. And that I think is fundamental in terms of making sure that customers are getting not only the investment returns, but also the liquidity that they need in terms of where they go. The other piece for me is most customers, if you think about the mass market and mass affluent, they don't really care whether you beat the FTSE 100 or, you know, the Dow Jones. What they want to know is that they've got enough money to buy their cup of coffee, pay their electricity bills, etc. So what we have to do is think about what are the outcomes that we're basically trying to achieve. And that's where I think something with a longer term, and that's where private assets absolutely come into play, I think is something that we need to think about. But daily trading is not something, if you're going to invest your pension, that's not something most mass market or mass affluent people really care about.
I think it's a real challenge for the industry, isn't it? Because as Peter referenced, the appetite to buy or maybe speculate on cryptocurrencies is huge, and there's FOMO is a powerful motivator, and it's how we create those stories in our industry to create that interest. I want to follow up with a question with you, Claire. Sorry, I'm going to put you on the spot again about scale, because you mentioned scale, and you mentioned a number of different business lines that you're involved in. Can you talk about how you're looking to achieve scale and how in a business the size of M&G you think about achieving scale in those different business units?
Yeah, so when I think about the value chain, I think about the advice, support and help that we give our customers. And to my mind, the face-to-face advice is very, very difficult to do at scale. So to my mind, that's actually about building the customer loyalty, giving the customer what they need in terms of support. When you go to things like the robo-advice, that is where you are going to get much more from a scale perspective in terms of technology. When you're providing the administration and the support, that is all about scale. It's all about technology. It's all about doing stuff in terms of the basics really, really well. And my honest view is you've got to be 100 billion plus to be in a place where commercially you can actually provide the outcome to customers in a way that you need. From an asset management perspective, clearly there are benefits from a scale perspective, particularly in what I would describe as the more vanilla types of assets. But it is about the solutions and how we deliver the outcomes to our customers. And therefore having that broad breadth of opportunity, whether it's through private assets, public assets, passive versus active, I think is important in terms of having all of those different elements in terms of where you bring. And some will be driven by scale and some won't. Some is about actually that value and the real personal part of whether it's the fund manager or the advisor in terms of what we're delivering. And I think we have to get it right as an industry in terms of where we're basically focused. Scale only works in certain situations.
Okay. Richard, hang on, I'm going to throw you the microphone so everyone can hear. Let's see if I can get, you ready? Cool.
Sure. Which bit do I talk into? Oh, there you go. Good throw. Question on something that Peter said, which was, it's probably an easy question to ask, it may be a hard question to answer, is we've got to find better ways to work with the regulators who are very concerned about outcomes that investors received, and in being concerned, perhaps inhibit some of the innovation that's being talked about. So, Peter, how might you, and how might we all work together to achieve what you suggest?
Yeah, Richard, as always, a very good question. I think we've got this is probably the single biggest issue which we all confront, because if we want to paint a picture of what the industry needs to look like on a 30 or 40 year view, it's not going to be, I think, the way the current mood of Stratford, to my mind, is that everything at the consumer end is getting nailed down towards smaller and smaller levels of risk, and everything in the wholesale end is being allowed to let rip, and there's a lot more desire to simplify and move forward. But that polarization, I think, is going to, if we're not careful, throttle the innovation which needs to happen for the rest of us. And I think it's part of having a regulator which is confident and functioning well and all the rest of it. And that's the first thing. And the second is us being clear about what it is that we're asking for. So, and I think at the moment, my sense is that we're all busy digesting, we've all just been digesting value assessments. Now we're digesting consumer duties. There's just a wall of new obligations that are coming at us. And it doesn't feel as if that's a two-way conversation. That's still, that they will tell us and we will comply. And to my mind, we've got to make that a two-way conversation of what's in the long-term best interests of UK savers. And I admire what they're trying to do in terms of cutting out the crypto speculation, but I don't think we've still got to focus on what gives you good long-term outcomes for people who want to save. Some of the points Andy was making about how he's able to provide signals on a platform, those would give better outcomes for people in the long term. Why would those not be helpful developments for our industry and for end customers?
Do you mind throwing it to April? Great.
Thanks for the shout out. So there's one other issue that I wanted to ask the panel about. So in the US and globally, the average age of a financial advisor is 60 plus. My own son thought about becoming a financial advisor and then told me he did not want to be a salesman. He did not go to college to be a salesman, and he works in operations now. So how can we as an industry, recruit the correct number of people to actually serve and provide the human interface that we need also? So I appreciate any thoughts that the panel has on that.
Before I come to the panel, the age in the UK, it's really encouraging. It's actually in the late 40s. That was from research that we did a couple of years ago, and we checked it with the PFS. So it's changing rapidly, but there is a certain shape to the market that exists, definitely. Who would like to maybe Claire, sorry to keep coming to you. I'd like to come to Claire and Tim on this, because you both, you have a financial advice business.
So it's definitely something that is a key issue for us in terms of how do we think about that next generation. So one of the things we've set up is a graduate, effectively academy, in terms of building out the next kind of advice or next advisor in terms of what we do. I think it also plays a bit to technology as well. So one of the things that we've definitely seen in the market in the last 2 years is the shift towards technology is forcing some of the advice businesses to then say, do I want to put that big investment in, or do I want to find a new owner who's basically got the pockets to basically invest? And certainly for us, that is a key part of why we have participated in that consolidation journey, partly because we want to be somebody who actually we can find a good home for the advisors. And as I said, we can offer that breadth in terms of opportunity, but also to provide from a customer perspective. But the one thing I would say is culture is fundamental to this. So if we're actually going to be able to do this, then what we've got to do is build the right culture in these businesses. One, so that they can work effectively side by side, but also that we're encouraging the right people in terms of what we believe the philosophy is. Because there is very much that philosophy of that salesman that we have to change in terms of them being effectively a professional and somebody who's valued by their customers, I think is really important.
And Tim, I'd be interested in your perspective on this, because one of the things we hear from financial advisors is one of the biggest barriers to recruiting people is just how hard it is to do advice sometimes, right? And how cumbersome it sometimes seems. And I know you guys have done a lot of work to try and make that process easier.
Yeah, I mean, I think it comes down to how can we simplify that advice process? So it touches a little bit on Peter's point of how do we work with the regulators so that there's less hoops to jump through, and therefore, it's easier for people. It comes to the cultural piece, it's not a salesperson. We had a big focus in my old world of banking the unbanked, and I think advising the unadvised is, something which for our industry, should be something that we regard as a important thing that we should be achieving. And one of the things that we're looking to do, sorry, a bit of reverb here, is if we can lower the cost of advice. So I don't necessarily agree that everyone will have to go down the robo route. I actually believe if we can streamline the advice process, we can decrease the amount that then you can, and if you link it to the customer outcome. So effectively, if I have my life plan, that requires I need a return of CPI plus 3, then my investment strategy should basically sit alongside that. Performance is sort of, to Claire's point, if it's better than plus 3, that's fantastic. But if it's not, then actually I've achieved my life plan. And then if I'm able to then deliver that, then that's a quality outcome. So I'm not selling at that point, I'm helping someone achieve their outcome, and that's, a fulfilling vocation.
Can I come back to Richard's point a little bit? One of the things we could articulate better to the regulators is it's perfectly accepted that everyone should go for a medical. What we haven't yet got in the UK is a culture that everyone should have a financial health check before they retire. So do it at 40, not at 60. And if we could get that mindset, we could then breed a generation of farmers, not hunters. So with our Schroeder Personal Wealth business, where we've got lots of referrals coming out of Lloyd's, we can have teams of advisors who are much more like farmers, who are not out, hunting the next client. They're taking a steady flow of referrals and managing them. And I think we need to articulate this need for really good advice for everybody, and that will change this dialogue and allow people not to be just sort of hunting their rich friends, rather than helping everybody have an advice point, because I think that's,
Absolutely.
but we need to sell the benefit of that advice.
Yeah, and you're right, by experiencing it. And, a lot of people, their first experience with it is when they get a mortgage or, those important financial decisions. And if more of those are happening online, it changes that dynamic of what the expectation is. I'm looking around the room because the way to save my voice is for you all to do your job here. So I'm looking around for who April should show the mic to. Great.
My name is Rebecca, and I work at a company called Ultimus, where they provide financial data. So I'm kind of just listening. I'm kind of curious to understand how your businesses have managed to adapt over the last 2 years during the pandemic. How you've managed to propel over the last 2 years in terms of either technology or financial face-to-face advice or robo-investing. So I am guilty. I have applied for various robo-investing apps, and I think it's just my curiosity. I've seen the adverts, and I kind of want to know more, and that is kind of what's intrigued me into getting or having some sort of financial advice, but more so robo. So I would like to understand from your perspective and from your businesses how you've managed to adapt and where the future, how you will continue to adapt in the future.
Andy, you've already talked about some of the reimagining you guys have done over the last couple of years. You mentioned Touched and Dawdle. Do you want to talk a little bit about how you've...
Yeah, I think some things I've been repeating myself, but I think that certainly COVID was a wake-up call to us all. I think it drove out paper processes that had been there for far too long, but also probably reinforced our view that we needed to, for a new type of audience, go back to square one. So that was probably taking the paper out really is a big focus in our business, and actually there comes a point where our Invest Centre platform will always have paper in you. There's certain assets you can hold on that platform that you can only access with paper. So I think to try and say we're going to take paper out of that was unrealistic, but the new proposition will not have a jot of paper on. I think on the data point again, we've got more data than you can shake a stick at on our customers. Again, back to my point before, we're just not allowed to use it in an effective way that is for the best benefit of the customer, and that's something that, you know, we have a list of things that we're lobbying on. I've got a meeting with Nicola next Monday, and it's going to be high on my agenda to say, look, we need to be able to use this data. You know, you can't give us consumer duty on one hand and then put all the barriers in, you know, in the way on the other. So, you know, very important that your data is what it's all about. You know, you hear, you know, all the industry are talking about it at the moment. A bit of a buzzword at times. You say, okay, well, there's only so much you can do with it, but I think it is about, you know, it's not about, well, I'm probably going to be careful what to say, it's more about nudging people in the future than sort of thinking that there's a whole host of data I've got there. I can use artificial intelligence. I hear people talking about that, and I start getting at least raise one eyebrow on that. But actually, I think there's an awful lot of data that we've got that we can just nudge people in the right direction for to end up in a better position.
It's really interesting, isn't it? Because we talk a lot about data and interoperability across the industry, but it's even the ability to use the data within an organization. And we've seen the powerful effect that nudges can have in workplace savings environment. Well, that's not really nudges, that was more just defaulted in. But anyway, but there's a lot of experiments being done about nudging people towards good behaviors. But you're absolutely right, being able to use that data as a hindrance. And AJ Bell, I should congratulate you, as recognized as a digital process champion by NextWealth for having mostly paperless processes. So well done for that. Does anybody else want to come in on that? Otherwise, I have a question on PE. I'm going to scan again after I ask my question. We've seen a huge amount of PE interest in our industry. It's been mentioned by a couple of people on the panel already. Tim, you're owned by a private equity firm. So how's it going? And So I mean, I have my own views about why private equity firms are interested in our sector, but I'd love to hear your views about that, and you know whether they're in it for the long term, and how that might shape our industry going forward.
Yeah. So it's not a quiet life, I think would be the first statement. I mean, so before joining FE Fund Info, which is owned by HG, I was also with Finastra, which was owned by Vista Private Equity, which is one of the other largest private equities. And I would say the combination between the two are that you tend to get a real focus on customer outcomes and value, and an understanding of where the value is that you're providing in your application. Of course, that's with a view to understanding and monetizing it to some degree, but it's a real focus on it. The second piece is really a focus more on adoption and enablement, that I think the traditional maybe technology providers and even other businesses focus more on the product and less on the adoption and people actually being able to use the product. And the third is, and you'll see this obviously from our own business in FE Fund Info, is a more of a willingness to buy, integrate and enhance than a traditional technology provider which tends to build, which, you know, there are pros and cons, and my chief product officer is in the audience, so I'll, you know, if you can join him later for a long discussion on the pros and cons.
He spoke on this stage at our last conference, in fact.
So, but essentially, from, you know, they're the three things that I find that they're very focused on. Now, there's obviously a lot of consolidation, you know, with M&G buying one of our clients, Sandringham, you know, and horizontal consolidation as well in the industry. So I would expect you'll find that sort of platform and bolt-on acquisitions to fill the customer journey, to enhance the advice process. You can expect to see continuing of that if private equity are involved in your marketplace. Similarly, in the advisors, you know, I would expect to see that within the firms, you can expect to see more consolidation because, you know, the panel's already discussed, scale is obviously a key benefit. If you can bring scale with simple, repeatable processes, you know, good client experience, then ultimately that battle is going to be for who can deliver the best client experience. And, you know, to the discussion we had earlier, capture not just the clients who are currently advised, but potentially their children. You know, we've obviously the big intergenerational shift of wealth people have been talking about for a decade, and managing that. And so that's one battle, and then the advisor efficiency is going to be the other battle. So from my perspective, in our business, you know, that's why we've acquired a number of assets over the last 18 months, both on the data side to round out that platform, on the application side and the integration to simplify that flow, whether it's in the advisor world or whether it's in the data. And my experience of private equity is they're very focused on that, and they're more prepared to move quicker and take more risk to get there than potentially standalone businesses. So I know that there's a perception, and I'll be honest that I may have had it myself when I first went in the private equity world, that it's all about here and now and maximizing returns. That's not been my personal experience.
And I think the important thing with private equity firms is it's an owner, and owners are different. Not all private equity firms are the same. And you see in the financial advisor market, there's clearly firms who are just hoovering up assets, and they're not looking to integrate. There's ones who are buying up assets to build a larger business, and there's ones who are really just about profit arbitrage, and they have different perspectives in terms of how they're building out and investing in those businesses, and I think that's a really important consideration. I don't know if anyone else wants to, because I know, Peter, your business is also in parts of it helping advisors find a route to retirement, potentially.
Yeah, look, I think the key point here is we've got a very, very fragmented industry. And what private equity, you've got high longevity of assets, you've got still high good revenue margins, high profit margins, which is part of the regulatory issue, and a need for the industry shape to change. So it's no wonder that they've stepped in, and we're not a private equity firm, but we are a long-term firm, and we're doing the same, but not using private equity money. And I think, to my mind, it comes back a little bit to the product point earlier. One doesn't have to be at the scary end of private equity to think there's all sorts of shades of private markets, and we tend to lump them all into that hairy bucket over here. But a wind farm can be a private asset as much as a private equity house, and I think it's thinking about what that particular firm is doing rather than they're all bad.
Yeah, absolutely. We have time for one more question. I'm looking upstairs because, Alex, I realize I haven't looked up if there's anyone upstairs who has a question, so I should be including you more. Any last question for our panel? There's one here, Richard.
Hi there. Peter, I was intrigued by your observation about values of investors as well as risk and return. That was a really interesting thing, and it's gone around my head since you spoke about it. Do you get any more thoughts on that, just to help me understand it better?
Well, I think we're in the foothills of getting there. I think this is a really hard area because we've gone, people will articulate it through you align with the SDGs and stuff and make it all about environmental. I don't think that's what it is. I think it is about, we all have different beliefs and different susceptibilities to risk, different susceptibilities to the path dependency of returns. One of my big issues is that many people can't live with the volatility of equity markets. They're just naturally not predisposed to it. One of my attractions of having more private markets is if you owned a stake in a wind farm which ground up of gradually 5 or 6% return every year, inflation linked, you probably think that's the best possible asset I could own, or a stake in a bridge, or an asset you could relate to. And so I would think of it in a much more broader terms than just saying this is about ESG investing, but I think as people understand their values and we find more compute power to understand what matters to people, what matters in their in their home life, and how do you match your investment portfolio to that, I think we'll start to have a different conversation with people rather than just the CPI plus 3 conversation. Because I just don't think that resonates. I mean, if 50% of people don't know what 50% is, there's no point in having a CPI plus 3 conversation.
Excellent. I think that's a really, really good note to end on. I'm sure we could go on for much longer, but I'd like you to please join me in thanking our panel, Claire Bousfield, Andy Bell. Hang on. Wait. They're so eager to thank you all. I didn't even get to thank you all myself. Tim Goodhind and Peter Harrison, thank you so much for joining us.